Welcome to Personal Finance for Long-Term Investors, where we believe Benjamin Franklin's advice that an investment in knowledge pays the best interest, both in finances and in your life. Every episode teaches you personal finance and long-term investing in simple terms. Now, here's your host, Jesse Kramer.
Welcome to Personal Finance for Long-Term Investors, episode 121. I'm Jesse Kramer. By day, I work at a fiduciary wealth management firm helping clients nationwide. You can learn more at bestinterest.blog/work. The link is in the show notes. And by night, I write the Best Interest blog and I host this podcast. I put out a weekly email newsletter as well, all of which help busy professionals and retirees avoid mistakes and grow their wealth by simplifying their investing, their taxes. And today is our 10th Ask Me Anything episode, and I'll answer questions like, is this new fad called direct indexing something amazing, worth pursuing, or just another fad to ignore? What happens when a couple has a lopsided retirement plan with one spouse retiring years, if not decades, before the other? We'll do a deep dive into decumulation, the order of operations and best practices around selling your investments to fund your retirement. But first, as always, we'll do a quick review of the week. This one is from Allie in Sacramento, who left a 5-star review saying, just the right balance. What a treasure this podcast is. Jesse strikes just the right balance between being fun and lively to listen to and sharing super detailed information. And he considers the total picture of personal finance. Very glad to have found his podcast and blog. I signed up for his emails and read each and every one. Allie, thank you for those very kind words, and I'm glad the weekly email has been helpful to you. I'd be happy to send you some treasure, Allie. That is a super soft podcast t-shirt, so please drop me an email to jesse@bestinterest.blog so I can get that sent out to you. And now on to the first question of our AMA. Question 1 is from Nikki. Nikki says, I've appreciated everything you have to say about tax loss harvesting and how it can be over-optimized. But what are your thoughts on direct indexing? The approach is being sold like you can get all the gains from a fund like VTI or a total market index fund, but with tons of losses you can harvest. It sounds intriguing, but is this placing too much emphasis on the wrong thing? Nikki, I think that's an excellent question, so let's do this. I'll talk a little bit about tax loss harvesting to provide some background there, and then I'll explain direct indexing through some rosy-colored glasses. Then I'll play devil's advocate and explain the downside, and ultimately I'll let you know where I land on the topic and whether it's worth pursuing. So again, tax loss harvesting is this strategic investment practice where investors sell assets at a capital loss to offset other capital gains. This minimizes their total taxable income. It's commonly employed to optimize investment portfolios and enhance your after-tax returns. And people might ask, why bother doing it in the first place? Well, you have assets in your portfolio with unrealized losses. Selling those losses turns the lame asset into a tool in your toolbox. And that tool can neutralize taxes, lowering this year's tax bill. That's not bad. And sometimes losses can actually carry forward and neutralize future year's tax bills. Any unused losses this year, they're tracked on your tax return and eventually can be used to cancel a future year's capital gain. Now, personally, I think that there are good and bad uses of tax loss harvesting. I think a really good use of tax loss harvesting is to offset some sort of liquidation event that would otherwise be occurring in your financial life. Maybe you're selling a business or a second home, because usually primary homes don't suffer capital gains taxes, usually. And so that's why I say you're selling a second home. And you might be facing a significant capital gain from that sale. Tax loss harvesting makes a lot of sense there, because in that scenario, you are making the sale anyway. You might as well seek out ways of saving money and reducing your taxes, because you're in the process of doing the sale and then realizing some capital losses. You are fundamentally reallocating your net worth away from the real estate or away from the business into something new. Perhaps it's just a traditional stock and bond investment portfolio. The gains and the losses are from different pools of money, which permanently offset one another. And that's a good thing. But as we'll see in a few minutes, that isn't always the case. Another good way of using capital losses, usually a good way, is to offset income. You can use tax losses to offset up to $3,000 a year in annual earned income. It's generally an excellent way of using tax loss harvesting. And the reason is simple tax rate arbitrage. Many taxpayers here in the US have a federal marginal tax rate of, say, 22% or higher. And every dollar of income they can offset with a capital loss results in a 22% or greater savings. Meanwhile, harvesting losses, usually it'll kick a can down the road, creating some sort of 15%, again, usually 15% capital gain in the future. And by saving 22 cents on the dollar today and spending 15 cents on a capital gain in the future, taxpayers can arbitrage that net 7% on their $3,000 for free. And the benefit becomes even more stark in higher tax brackets, 24, 32, 35%, and becomes even more stark if your future capital gains you can actually realize at 0%, because that's possible too. Another common tax arbitrage occurs when an investor might owe capital gains at the 23.8% bracket, which, if we're being technical here, is 20% on capital gains and 3.8% on the net investment income tax, 23.8 total. Well, in that case, a loss can offset those gains, saving 23.8%. Again, probably resulting in a 15% capital gain in the future, or maybe a 0% capital gain in the future. But either way, that arbitrage is a deal that we would take every single time. I think whenever we're talking about tax gain or tax loss harvesting, we should remember there's a very specific order of operations that the IRS uses, a specific order for how losses can offset gains. First, short-term losses offset short-term gains. So think of this as the short bucket. And then long-term capital losses offset long-term capital gains. So that's the long bucket. Then if you still have net losses in either bucket, they will be used to offset the net gains from the other bucket. So capital losses always offset capital gains first, no matter what. Short offsets short, long offsets long, and then if you have any losses left over, they kind of leak over into the other bucket. After you've already offset all of your capital gains, then you can use any remaining capital losses to offset your earned income up to $3,000 of income per year. And then any remaining capital losses carry forward into the next year. It's important to remember that there is this order of operations for the way that capital gains are used. And then last, I'll use an example actually to talk about this one, a good way that tax loss harvesting can be used, because actually I have two clients going through this right now. They have extremely concentrated stock positions in a specific company. Coming into this year, both of these families had probably 20% of their net worth in this one company, due to years of stock options, years of restricted stock units being given to them. And then in 2024, this stock was up about 55%. So far this year, this stock is up another 70 to 80%. And I suppose the first listener who emails me with a correct guess on this stock and this company, I'll send you a super soft podcast t-shirt for getting the guess right. Up 55% in 2024, up another 70 to 80% so far here in 2025. But anyway, the point is that it was very valuable for these families to put a plan together to diversify out of their concentrated positions. But that realizes a lot of capital gains, and using some capital losses to offset those gains makes a lot of sense. Anyway, the point is we put a plan together for these families to begin diversifying out of their concentrated positions. And despite our best laid plans, the concentration is actually worse now than ever before because the stock is going up so quickly. It's kind of a wild situation, but okay, that's a good problem to deal with. But the point is that these are capital gains that both of these families should be realizing. And the reason they should be realizing them is because of portfolio construction and investment merit. There are important portfolio investing reasons to diversify. Whether they pay 0 or 15 or 23.8% in capital gains, they need to diversify anyway. Thus, for these families, tax loss harvesting is very smart. You might as well intentionally realize losses to offset the mammoth gains that they are incurring from their diversification needs. And I'll contrast that to someone who owns a lot of, say, the S&P 500 index fund, and they've been buying shares of that index fund every month now for years and years and years. And back in April of 2025, just a few months ago, at the bottom of the quote-unquote tariff tantrum, that person would have found that many of their more recent S&P 500 shares are underwater, sitting at a loss. The index was down almost 20% from its high watermark. And that person could have sold all their newer S&P 500 shares for a loss, but then also sold some even older S&P 500 shares for a gain. The losses could have offset the gains, negating any tax impact, which feels good. And then they could have used all the proceeds from those sales to buy a different index fund, because we have to be careful of this thing called the wash sale rule. You have to pick a different index fund. It's within 30 days before or after your sale. But then boom, they stay invested in the market and they avoided some taxes. Well, not quite. That's not right. Because if you actually look at how all the numbers work out, they took a bunch of gains and a bunch of losses, and those numbers offset each other. And therefore, they sold a bunch of their S&P 500 shares at a net zero gain or loss. Then they turned around and bought, say, a total market index fund at current market price, which by definition means there's a net zero gain or loss. And what I'm describing is that their cost basis has not changed. The point from which we measure capital gains hasn't changed. All they've done is shifted net zero gains from the S&P 500 index fund to a net zero gain in the total market index fund. Their tax situation, their capital gain situation was net zero yesterday, and it is net zero today. They changed from a S&P 500 index fund to a total market index fund, not because of investment merit, but because they falsely believed they were saving on taxes. Okay, but what does this all have to do with direct indexing? Direct indexing lets investors build their own personalized version of an index, say like the S&P 500 index, by not owning a fund, but by owning all of the individual stocks directly. So, right, you're not buying an ETF, you are owning all of the individual stocks directly. This approach gives more flexibility. Investors can customize their holdings, maybe by excluding certain companies or industries. Yes, they can harvest tax losses on specific positions. That's kind of one of the appeals. They can control when capital gains are realized, another one of the appeals. And direct indexing used to be limited to the ultra wealthy investors because of some of the complexity and the cost of setting it up. But new technology and then also fractional shares has made direct indexing much more accessible to everyday investors like us. So in short, it is indexing, but with a little bit of personalization and tax optimization built in. Now, here's the rosy-colored optimist's sales pitch for direct indexing. It's that it's for investors who want the power of indexing with a personal touch. It keeps broad diversification, which we like. It keeps relatively low costs, which we like, but it adds in customization and it adds in control. We can tailor our portfolios to reflect our values. Maybe if we are into green energy, we avoid fossil fuel stocks and we double down on clean energy. So we have our values in our portfolio. And then we optimize taxes through loss harvesting. And then over time, that tax efficiency should meaningfully boost our after-tax returns. And it's also very transparent. We see every single stock we own. So in a best case scenario, direct indexing delivers higher returns, lower taxes, and a portfolio that perfectly reflects our personal goals and beliefs. But here's the pessimist's rebuke. It's that direct indexing sounds revolutionary, but much of the hype really has outpaced reality. It's sold as better returns and lower taxes and more control, but those benefits really depend on active management and some discipline that many investors don't maintain. The tax harvesting edge is something that I think shrinks over time and actually can disappear in rising markets, just like markets we've seen recently. And then the customization part of direct indexing leads to something called tracking error, which I will define in a minute, where your portfolio doesn't match the index at all. And while fees of direct indexing have dropped, they still carry significantly higher fees than traditional indexing. And for many reasons, in many cases, I should say, investors would just be better off sticking with plain low-cost ETFs. So let's actually dive into a little example. In any given year, we know that some of the 500 companies in the S&P 500 will be up and others will be down. A direct index allows us to sell some of those down companies or some of the shares of the companies that are down to realize those losses and then to use those losses for tax minimization in other areas of our financial plan while still maintaining this greater skeleton of the S&P 500 index. But a direct index doesn't exist inside of an ETF wrapper. Instead, you directly own the individual stocks, and that ownership is what enables our customization and loss harvesting in the first place. So that's something that ETFs can't do internally, but it also introduces some natural inefficiencies. More trading, smaller tax lots to manage, and then higher transaction costs and more tracking error. An ETF, though, in contrast, extremely efficient. It nets out trades internally. It defers capital gains out to the future. So while direct indexing offers flexibility and personalization, it cannot fully replicate the structural efficiency and simplicity of an ETF. And now I've used that term tracking error a couple times. Tracking error is the difference between your portfolio's performance and the benchmark it's trying to mimic, like in our case so far, the S&P 500. Tracking error is a measure of how closely or not your results follow the index. And that tracking error is caused by the customization choices or the trading delays or the intentional realization of losses along the way. And one of the problems with direct indexing is that the better it works at realizing tax losses, the greater its tracking error will be. Next thing you know, you're not really going to own the S&P 500 anymore. You've created a portfolio that has some of the S&P 500 companies, but also has some holes where other S&P 500 companies used to be, because those are the companies that had the losses that you realized to make it a direct index. And you end up with these not huge concentration risks, but still an accidental concentration risk where you wanted to have an index instead. And then last, we need to think back to the previous stanza about good and bad uses of tax loss harvesting on the whole. Because if you're realizing losses simply for the sake of realizing losses, and then you're somehow redeploying those proceeds back into the portfolio, you might not actually be changing the cost basis of the portfolio, right? You're just playing hot potato with the cost basis, deferring capital gains out to some future date. And all of these are examples where we're choosing the tax tail over the investing dog. And that's usually, not always, but usually the wrong thing to do. Direct indexing, at the end of the day, it's sold as this mimic of the index itself, but with the ability to realize more losses. And in reality, I would say that we're choosing to accept tracking error in exchange for losses. And unless we have a smart way to utilize those losses for legitimate reasons, for actual investment merit, for actual financial planning merit, then we never really needed those losses in the first place, right? Unless we're using them really well. And in the example of a S&P 500 direct indexing, the fees might be in the range of 30, 40, 50 basis points that aren't necessarily outrageous fees, but they're 10 to 20 times greater than the fees for a simple S&P 500 ETF. So my final verdict, if you showed me, again, I'm working here and under the American tax system. If you showed me 100 typical Americans or even 100 typical listeners of the show who tend to be more financially literate, wealthier than normal, more apt to have some complexities in their financial lives, even that being said, I would bet you that fewer than 10 of those 100 people would be a truly good fit for direct indexing. Or another way of saying it, I bet that 90 of those 100 people would be worse off for pursuing direct indexing than if they stuck with a simpler path in the first place. Here's a quick ad, and then we'll get back to the show. Every week, I send a quick free email to thousands of readers that shares 3 simple things. 1, my new articles and podcasts. 2, the best financial content of the week from all over the internet. And 3, a financial chart that explains some important concept in the news that week. It's a great primer to boost your financial know-how.
But Jesse, I don't want another email.
Well, this might not be for you. But I do hear you, which is why I make it very short, sweet, and full of only the essentials. A whopping 66% of subscribers read my email at least once a month. They're enjoying it, and maybe you will too. You can subscribe for free on the homepage at bestinterest.blog. Again, that's a free, no-strings-attached subscription at bestinterest.blog. Thank you for that awesome question, Nikki. And now on to question 2 from Kevin. Jesse, a future podcast idea: how to approach financial and tax planning when a couple has a lopsided retirement. One spouse early, the other spouse retires late. This is my fortunate situation with my wife working in the financial services industry, making a very good living. We have always filed our taxes as married filing jointly when I was working, but I wonder if there would be an advantage to me if we changed our tax filing approach so that I could benefit now that I'm in a lower tax bracket if I were filing single. It's a long suggestion, but I hope this idea makes sense over email. Kevin, it definitely makes sense. So let's make sure, listeners, we answer both parts of Kevin's question today. The first part is, what are some general considerations for a couple who plan on retiring at vastly different times? And then the second is more specifics on those tax thoughts, whether to file separately or jointly. We'll kind of dive into that a little bit. Again, not an accountant. This isn't tax advice per se, but I've done enough tax planning to know my way around this conversation. First, the general thoughts. I don't want to discount the soft side of retirement, so let me first point out the psychological impact. There might be a really big change in household lifestyle when one spouse retires years, if not decades, before the second one. Most retirees face new, unforeseen shifts in identity, activity versus boredom, social circle changes, that kind of thing. And I would assume it's probably exacerbated when the two spouses are retiring at vastly different times. My first thought, Kevin, is about cash flow. It's true for just about any single retirement plan. When you guys go down to one income, my main question would be, will you now have to start living off of some of your investments and investment income, or does your wife's salary cover all the household expenses? If you do have to draw on your assets, Kevin, that opens up an entire can of worms. The next question today will be all about decumulation, so I won't dive too deeply into decumulation right now. I think that medical coverage is another thing to be aware of. I'm assuming you could probably both easily and relatively cheaply go on your wife's employer's coverage, but it's worth knowing in advance. Let's pivot now specifically to the tax question, and we'll talk about the difference between married filing jointly and married filing separate, which I'll just call joint and separate to be clear. The vast majority of the time, filing jointly is going to be better than filing separately. It's only beneficial to file separately in a few specific circumstances. Namely, those are circumstances in life where maybe you can't trust or you can't get along with or you can't contact your spouse. In some cases where your spouse owes back child support. Maybe if you have to file a state return and it comes out better filing separately than jointly, and also the state requires you to match your federal filing status, that can happen. And then there's certain student loan and other kind of federal loan repayment situations where filing separately makes more sense than filing jointly. They really are corner cases. In general, Kevin, it does not make sense for retirees to file separately, even in your situation. Filing jointly means that the higher earner can essentially use the unused space from the lower earner's lower tax brackets. Filing separately disqualifies you from that idea. It also disqualifies you from a variety of credits and deductions. Also, if one spouse itemizes deductions, the other spouse is required to also itemize deductions and cannot take the standard deduction, which would probably hurt in your situation. Filing jointly usually has lower tax brackets and rates, allowing more income to be taxed at lower rates. Filing separately, rates are generally higher at lower income levels, meaning you often pay more tax. I'll just use a round number, Kevin, in your situation. Let's say that your spouse earns $300,000, Kevin. I'll assume no other income, just to make it easy. No interest, no dividends, just $300,000 of W-2 income. If you file separately, the tax on that income would be $69,000 and change. If you file jointly, the tax would be $50,000 and change, a full $19,000 less in federal taxes. Now, to your point, Kevin, maybe you're in early retirement. So what if you, Kevin, are trying to do Roth conversions? So what if you now have your wife's $300,000 plus $100,000 in your Roth conversions? The income is Kevin's wife's. The Roth conversion is Kevin's. If they file separately, those burdens would be separated out. So if you do file separately, the two taxes would be $69,000 and change, the same as we just discussed for the W-2 income. And then on your Roth conversion, Kevin, would be $13,600 for a grand total just shy of $83,000 in taxes. If you file jointly, the combined tax would be $74,000 and change. $83,000 versus $74,000. These numbers are closer than the first situation, but married filing jointly still makes sense. The difference in standard deduction is another important difference here. Filing jointly for a couple under the age of 65, here in 2025, you would get $27,700 in deduction. And if you file separately, you each get half of that amount. You each get $13,850. But Kevin, if your income in retirement is extremely low, it might mean that some of your standard deduction essentially goes unused, which is another reason to file jointly so that your high earning wife can use the entirety, I should say, of both your standard deductions. I mentioned earlier that credits can change. So when you file jointly, you basically get to claim all of the standard credits, the earned income tax credit, child tax credit, education credits. When you file separately, many of those credits are disallowed. There's some other ones worth knowing too. There's issues when you file separately about itemizing deductions. There are much lower phase outs for IRA deduction limits. There are much lower phase outs for Roth IRA contribution limits. There's usually higher Social Security taxation. And then there really are only a few corner cases where filing separately makes sense. The student loan repayment corner case is one, which if you're interested, you can kind of Google some examples of that. And then I would say the liability issue is the other one, where if you file jointly, both spouses are jointly liable for any underpayment or adjustments. Whereas if you file separately, each spouse is only responsible for their own return, which in situations where your spouse is separated or you don't trust your spouse can protect you if from your spouse essentially making a mistake on their tax return. So in short, Kevin, I think there are rarely any cases where married filing separately makes sense, even in a case where you're retiring a decade before your spouse. But as always, something I would encourage you to do is there are some 1040 calculators online. I use one on the Guidestone website, the Guidestone 1040 calculator. And I'd encourage you, plug some numbers into the 1040 calculator, change the filing status from joint to separate, and just see in your situation if it makes sense or not. So thank you, Kevin, for that great question. And now on to question 3 from Isaac. Isaac said, if you were to dedicate a whole episode to one topic, for me, the most useful topic would be on the ins and outs of decumulation in retirement. I'm hoping to retire in a couple years, so this would be really helpful. I know hiring a financial planner is one option, but what about for the DIY folks? It looks like annual withdrawals would be the easiest way to approach this and would really like your thoughts. Bill Bengen's 4% rule, I believe, is based on a 30-year retirement, but what would be the good drawdown rate for someone retiring at 55? I know a fixed withdrawal amount doesn't make a lot of sense. However, it would be good to know what appropriate drawdown rate would be as a reference point. Yeah, I think it's easiest, Isaac, to start tackling the second part of your question first and to answer it relatively subjectively, at least right now, because there's been a ton of really good work, extremely good articles and podcast content and YouTube videos, depending on if you're listening to a podcast, maybe you like listening to podcasts. So I'll start with that one. But there's been so much good content over recent years about the good, bad, and ugly of the 4% rule, whether the 4% rule is still valid, whether it should be more like the 4.7 or the 5% rule, misunderstandings of what the 4% rule is even based on in the first place. And then to your point, Isaac, the fact that the 4% rule shouldn't be static, the fact that it should be dynamic. And how exactly is it dynamic? Do we use some sort of guardrails approach? Do we just accept the fact that there's variable spending in retirement and then try to plan that spending as best we can and then run a Monte Carlo analysis on that spending to see how it would survive over 25, 30, 40 years or more? You can try all these things and they all have merit to them. But I think at the end of the day, the point is that for any 55-year-old, in your case, Isaac, to look at their portfolio, let's say it's got $1 million in it to keep it easy, and to say, yeah, I'm going to spend $40,000 here in year one, 4%. I'm going to spend $40,000 exactly. And then in year two of retirement, I'm going to adjust that up for inflation. So 40,000 becomes, 41,500, something like that. And that's exactly what I'm going to spend in year two, on and on and on. To have that rigid of a structure of spending, we just know that's unrealistic. And so rather than doing that, I think the much smarter way, and the way that I usually approach it myself, involves using some financial planning software, estimating as best we can what our cash flows will look like, at least over the coming 5, 7, 10, 15 years. I mean, most of us can make pretty reasonable assumptions on that. I know we don't know how inflation will affect us, but we can look at our lives. We can look at maybe our children. We can look at big events coming up. And we might know when we have college payments due. We might be able to just pencil in when we're going to contribute to a child's wedding or something like that. And then we know our lifestyle costs. And so we can look out, we can even build in some lumpy costs intentionally. We can say, I assume every 3 years, I'm going to have this extraordinary cost that's $15,000. The point is that we can build out a cash flow in a way that more resembles reality, isn't static, but has a little dynamism to it. And then we can run a Monte Carlo analysis on that. There's some really cool guardrails approaches out there that exist that basically say, at any given time, using some sort of historical backtest, I want to have an 80 or 90 or 95% chance of retirement success, or maybe even lower, maybe a 60% chance of retirement success. It's really in the eye of the beholder. It's up to you as the one who's deciding to pull the retirement trigger, how you want to approach it. But the point is that you can adjust your withdrawals over time such that when times are good, in order to have your 90% chance of success, you can actually increase your spending. And then when times are bad, in order to maintain that 90% chance of success, you have to throttle down your spending. It builds dynamism into it. Dynamism, though, in that case, isn't necessarily based on what you want to do with your money in that particular year. Instead, the dynamism is a function of how is the market performing and how much have I withdrawn before. In other words, there might be some times using those guardrail strategies where you've been planning this trip to Europe for 3 years and you have every single detail penciled into your notebook. And yet, because the market happened to drop 20% 6 months ago, your guardrail strategy informs you that you can no longer afford that trip. So my point is that, there's pros and cons and gives and takes, I suppose, that do you want the market to dictate exactly what you spend at all times? Maybe I'm not explaining that perfectly. Maybe I'm being a little overly critical of guardrail strategy, because I do think the guardrail strategy is really interesting, really smart, actually. It's just a matter of whenever we do financial planning, we have to accept certain risks. And one of the things we have to accept from a guardrail strategy is that the strategy itself and the returns that the market gives us might at times throttle down our spending when we've been hoping to spend more. And that's just something we have to accept. So now that's my subjective answer to Bengen's 4% rule, to altering it to live a more dynamic retirement, to live a retirement that is fewer than 30 years or more than 30 years, to avoid the fixed withdrawal amount. So that's where I'd start that answer, Isaac. And I'd encourage you to go out and check out some of the resources that I kind of referred to there. Now, when it comes to the actual retirement order of operations, retirement withdrawal order of operations, I'm going to throw a link in the show notes to an article I wrote in June. The article is titled, your retirement withdrawal order of operations. It is a long and kind of deep article. And one thing I'd point out about this article, it's not a light read, but I encourage you to read it nonetheless. I think it's a very deep and good read. And what I've done in there too is I've linked to a bunch of other helpful decumulation articles, like how much can you safely withdraw from your portfolio each year? How should you tax optimize where your assets live? What assets should you own? How much risk should you take? How do you design a good portfolio? Questions like that. But enough preamble. Let's start with the foundational concepts of retirement withdrawals. The core of retirement withdrawals, usually we have one of the following goals. We want to maximize our after-tax lifetime income. We want to ensure we can always spend what we want to spend. And we want to ensure that we can give in life or in death to people or causes that we care about. And no matter that personal goal, it's essential to understand, among many other things, some of these following aspects of your situation. And we'll dive into each of these over the next few minutes. We need to understand investment longevity requirements. We need to understand how to minimize market and longevity risk, tax efficiency, the various tax status of our accounts, our income needs and our lifestyle goals, required minimum distributions, Medicare IRMA brackets, ACA subsidy cliffs if we're retiring before 65, and legacy or charitable goals, among some other things. So those are some of the keys that we need to follow. But first, let's start with the standard withdrawal order of operations. My metaphor, my analogy here, maybe it's not the best one, but imagine we're sitting inside of an auditorium. And in the auditorium, it's kind of like one of the kind of classic concert halls. And there are a lot of these doors on the side. There's some doors behind the stage. There are many, many side rooms in this auditorium. So when you walk into the back of the auditorium, you can look around and you get a really solid overview of the space that you've just stepped into this large hall. You see the size, you see the seating, you see the stage, you see all the main aspects. But from where you are in the back of the auditorium, you can't really look into all the little side doors and side rooms. If you want 100% understanding, you need to spend some time exploring each of those small rooms. And I think the retirement withdrawal landscape is kind of similar to that. So over this time, over the next few minutes, I'm going to describe the large auditorium of retirement withdrawals, and I'm going to provide a solid overview of that space. And I'm going to allude to many of the small side rooms and maybe even peek inside a few of them. So I think most of you are going to walk away with this adequate lay of the land. And quite a few of you, in fact, will walk away with enough information to probably completely plan your retirement withdrawal strategy. The rest of you at least will feel comfortable, but maybe you'll want a little bit more details about the specific side rooms that apply to you. Here's a quick ad, and then we'll get back to the show. I still remember it was 2019, and a guy from Fidelity came in to speak to my then employer about personal finance in general and about our 401k plan in particular. There were 60 or so of us who attended, mostly 50 plus years old, clearly with retirement on their minds. And nothing against this individual from Fidelity, but unfortunately, the guy just didn't really know what he was talking about. It ended up being a major disappointment. And a bunch of my colleagues afterwards said, in short, man, we're really thirsty for good financial retirement information. Where do we go find it? Now, does that sound true, listeners, for you and your colleagues? Last year, either in person or via Zoom, I spoke to about 800 employees at 11 different organizations, sometimes about personal finance in general, sometimes about specifics of their retirement plans, sometimes about the nitty-gritty details of Social Security and withdrawal planning and retirement math. The point being, if you're interested in inviting me to come talk money to you, to your colleagues, where you work, that is absolutely something I'm interested in talking to you about. Simply drop me an email to jesse@bestinterest.blog and let's start a conversation. So let's talk about that large auditorium, the standard withdrawal order of operations. What follows are rules of thumb, not laws. They're rooted in logic and tax math. At its core, this particular framework is about maximizing after-tax income over your retirement years. And if I neglect to say it, I want you to continually imagine the phrase, if you still need money. And so this might go without saying, but if you don't need the money, you shouldn't withdraw anything. You should allow your portfolio to continue to compound. But rather than say, if you still need money a million times over the next 5 minutes, please imagine it's there. So in the order of operations here, taxable accounts come first. You should first withdraw money from your taxable accounts. If you have extra cash in your bank account that is extra beyond your emergency fund, spend that first in retirement. It's a no-brainer. Next, you want to tap into the interest and dividends that might have accrued in your taxable brokerage investing account. You're going to be taxed on that money anyway in the year that it's been paid out to you. It's better to use that money on your monthly spending needs than reinvest it and realize other taxable income elsewhere. Typically, though not always, and this is why this is one of those small side rooms, so typically, though not always, you should next realize capital gains in your taxable account. Long-term capital gains have preferential tax treatment compared to normal income. And when I say normal income, one example of that would be withdrawals from traditional retirement accounts. Traditional tax-deferred retirement accounts come out as normal income. You'd rather realize long-term capital gains than realize normal income. Selling from a taxable account also creates cost basis flexibility. You can choose which lots to sell. You can manage gains and losses to control your taxes in some cases. You can realize capital gains maybe even at a 0% tax rate in years with little to no other income. Not bad. After you've realized taxable accounts first, tax-deferred accounts come next. Traditional 401k and IRA accounts. These are accounts where you haven't paid a lick of tax yet, but each dollar you withdraw will be treated again as income and therefore subject to income taxes. Ideally, though, you won't touch these accounts until after age 59 and a half. Though, here's another small side room. There are interesting workarounds to this age limit, such as 72T, substantially equal periodic payments, or SEP. The rule of 55 is another one, which applies to, I believe it's 401k accounts. If you retire from an employer when you are 55 years old or later, you can pull money out of those 401k accounts without paying any sort of early withdrawal penalties. So these withdrawals out of your traditional IRA accounts are taxable as income, and they will affect other parts of your financial plan, such as your marginal tax bracket, Social Security taxation, Medicare IRMA brackets. Nevertheless, starting with withdrawals from tax-deferred traditional accounts from an earlier age can be a smart thing to do. Doing so helps mitigate larger RMDs in the future that might push you into higher tax brackets or affect your Medicare premiums. Roth conversions can certainly accomplish the same exact goal, although the converted dollars don't end up as spendable money usually. I mean, they go into your Roth IRA and you might not want to immediately spend them out of your Roth IRA. Something called bracket stuffing is a pretty common tactic here too. Not to be confused with the Thanksgiving dish, depending on when this episode comes out. But bracket stuffing describes the process of intentionally taking tax-deferred withdrawals, or more commonly using Roth conversions, to stuff your particular tax bracket until it's quote-unquote full of income before getting pushed into a higher bracket. The goal is to maximize or to fill your lower tax brackets every single year, especially, again, if high, large RMDs are somewhere in your future. The caveats here are to ensure that you have enough cash on hand to pay your taxes, to be wary of IRMA territory if you're already of Medicare age, to understand how your Social Security taxation might be affected. I can't recommend this enough. You or a professional you hire should understand enough about the federal 1040 tax return to at least lightly dig into your specific tax scenario. Again, I'll link in the show notes the Guidestone 1040 tax calculator. A reason why I'm talking about it right now is because it's free and it's easy. It's certainly not a professional tax planning software, but it's a free, easy, Googleable 1040 tax calculator that at least it's enough to be dangerous. It's enough to know if you're kind of walking into murky waters. And then last in this order of operations are tax-free accounts, Roth and HSA accounts. Tax-free accounts are the holy grail of retirement planning. No, they don't provide eternal life, but perhaps a better metaphor is like a joker or a wild card. In a tight tax bind, you can withdraw money from Roth accounts, or in the case of HSA, for qualified purposes, for medical purposes, with zero tax consequence. And so why do we want to save them for last? I mean, they are your MVCs, not MVPs, but MVCs. They are your most valuable compounders. Unlike your dollars that compound with capital gains taxes attached to them, or your dollars in tax-deferred accounts that compound with an income tax attached, a Roth or an HSA dollar compounds tax-free. Second, they're not subject to RMDs. You can let them compound forever. Third, your Roth dollars are ideal for legacy giving and estate planning. Your heirs can inherit those Roth assets, let them continue compounding, and then withdraw them after 10 years without any tax consequence. So again, that's the 10-year rule of an inherited IRA. And I'll say this idea of leaving these tax-free assets to heirs, very good for Roth. This idea does not apply to HSA dollars. You can do what you want, but I would not recommend that you leave HSA dollars to a non-spouse heir, and we'll discuss the reason why later. And last, when it comes to HSAs and Roths, these dollars provide a lot of tax flexibility later in life when RMDs and or IRMA surcharges can become bigger concerns. Again, not always, but they can become a bigger concern. So imagine an additional surprise expense pops up in your late 70s. You already have medium to high RMD income, and to cover your unexpected need, you might have to realize capital gains at 15 or 20% tax plus the 3.8% NII tax. Or you might have to realize income at 24 or 32% or higher tax plus state tax. Or you could just withdraw some money out of your Roth accounts tax-free. That's a pretty nice safety valve to have at all points throughout your retirement. So Roth dollars and HSA dollars should generally be the last dollars you withdraw. And that's the auditorium. That's the big room that we've just walked into. Taxable accounts first, especially with the cash you already have and with the cash that's foisted upon you from interest and dividends. Tax deferred accounts next, mainly because you don't mind realizing some taxes at lower rates and you'd rather not touch your Roth accounts too soon. And then tax-free accounts last because these are your MVCs, your most valuable compounders. And this is the starting point. We haven't explored the small rooms yet. As your retirement unfolds, many other scenarios can affect when and how to tweak that order. The first side room we'll explore involves Roth conversions and tax bracket management. I've written extensively on these topics before. I recommend you start with the previous articles I've written, Should You Consider Roth Conversions and the Powerful Benefits of Roth Conversions. These links, again, are in the article. The article is in the show notes, Retirement Withdrawal Order of Operations. The critical details, though, are that we want to use our early retirement years for Roth conversions, usually. These years tend to be lower income, and you'll typically be pre-RMD. You might not have started Social Security yet even. Those low-income years can be used to intentionally and artificially realize income in lower tax brackets by converting dollars from our tax-deferred accounts into our tax-free accounts, accomplishing the very bracket stuffing that we described before. Now, is that a guaranteed smart tax move? Well, we each have to make a judgment call. How do we feel about today's known tax brackets versus tomorrow's uncertain tax brackets? It's not always an easy wager, but if we feel comfortable that taxes will remain stable or increase, then Roth conversions are a smart move. The goal is to avoid these nasty future tax scenarios, kind of like the unholy interference of RMDs and Social Security. In retirement, these extra dollars of income that you realize don't just create their own tax bill, but they can also pull more of other earnings into the taxable column. So the goal here is to utilize the tax base that you can smartly and to simply add more into your most valuable compounders on the balance sheet. So the next side room I want to explore is when and how to break our standard order of operations here. And the first reason why is to fill gaps with Roth withdrawals. So in general, again, your plan should be measured in decades. We want to think far ahead. And after looking far into the future, you might realize that you'll pay high marginal taxes during your early retirement years. And that might stick out like a sore thumb compared to the rest of your plan. So instead of paying those high marginal taxes, you might want to fill the gap with early Roth withdrawals. So again, rather than realizing capital gains at a 20% plus 8.8% NIIT tax, rather than withdrawing from traditional tax deferred accounts at 32% at the federal level and 7% at the state level, maybe you just make a simple Roth withdrawal with no tax consequence. The same strategy can manage IRMA costs or ACA subsidies or other income cliffs. And when I say cliff, what I mean is that most tax rules have a gentle slope to them, such that, being $1 over a certain limit doesn't punish you immensely. But other tax rules have a cliff where if you're $1 on the wrong side of that cliff, you fall all the way down. And usually tax cliffs are, in my opinion, stupid, where, going just $1 over can result in thousands of dollars of extra costs or penalties. And so if you need $500 more in a particular year and withdrawing that $500 from a traditional IRA would push you into the next IRMA bracket, into that cliff, well, stop. You can make a strategic tax-free withdrawal from a Roth account instead and avoid falling off that cliff. I think another potential reason to break some of the standard order of operations is to look at the cost basis in your taxable accounts and realize strategic opportunities for tax loss or tax gain harvesting. Again, we already talked about tax loss harvesting today. I won't go into that. Tax gain harvesting is when we can sell an appreciated investment and realize the gains, intentionally realizing those gains while we're in a low tax bracket, often resulting in little or no tax owed. that opens up other strategic doors in this auditorium. And it's interesting where different strategies can take precedence in different years. So in some years, tax loss harvesting might open up an opportunity for extra Roth conversions. In other years, tax gain harvesting might be smarter than pursuing those extra Roth conversions. And if you're interested, I did write a pretty comprehensive article about when and how to choose Roth conversions over tax gain harvesting and vice versa. We can link that in the show notes. But taxable cost basis is a pretty funny thing because any sort of tax loss or tax gain or capital gains minimization strategy highly depends on your age. And not to be crass here, but cost basis optimization basically becomes a moot point when you die. Your heirs are going to inherit your taxable assets at a stepped-up basis. So if you're 60 years old and healthy and considering the side room of cost basis manipulation and optimization, good for you, go for it. If you're 85 and you're in a nursing home and you're taking a hard look in the mirror, well, you might not want to do any of this stuff in your taxable account. On that note, another side room we can explore is optimizing for post-death. So it's worth asking yourself, will I be leaving money to heirs after I die? And if I am, how do I do that optimally? Leaving money to your spouse differs drastically from leaving money to any other person in your life. Leaving money to charity has special rules about it. Some accounts are much better going to charity than others. And if you're giving to charity while you're alive, there are really smart and really dumb ways that you should be doing that too. Leaving money to high-earning heirs should be fundamentally different than leaving money to low-earning heirs because their tax situations can affect the benefit or the annoyance of your bequest to them. So leaving money after your death is another important side room when it comes to optimal retirement withdrawal strategies. Next, I want to talk about the role of Social Security timing. When designing someone's retirement paycheck, we generally think about fixed income sources first. We want to understand your Social Security income before determining your withdrawal order of operations, but I still wanted to touch on a few key points today. Perhaps the biggest question is, when should I start taking Social Security? So rather than reinventing the wheel, I suggest you read my article titled, When Should I Take Social Security? The key takeaways are that Social Security can, and in some cases should, be a pressure release valve on your portfolio withdrawals. But delaying Social Security can be a very important door in your withdrawal strategy. Namely, it increases opportunities for Roth conversions and provides longevity insurance. Social Security taxability is another important topic. It's worth knowing how other retirement income may affect your Social Security taxation. I recently wrote an article about spousal benefits, survivor benefits, and even divorcee benefits. We'll link that in the show notes, but it's really important to understand how to optimize or maximize the different spousal and survivor benefits that you might receive. Okay, I've got a couple more side doors. The first one is when people ask, well, what about my HSA account, my annuities, my pensions, etc.? So HSA accounts, health savings accounts, are highly valuable. Again, they're somewhat like Roth dollars. When used for medical expenses, HSA dollars are tax-free, most valuable compounders. But what happens if your HSA is too big such that you might never spend it? So first we should answer, what happens if you die with HSA assets? If you leave the HSA account to your spouse, the account effectively becomes their HSA with all the excellent tax-free benefits for them. But if your spouse has passed, or you simply want to leave the HSA to another person, then the entire account becomes taxable income to that beneficiary in the year of your death. Ouch. So that is not an ideal outcome. You've taken your most valuable compounders and you've basically given it away entirely as taxable income all in 1 year. For that reason, it's worth considering a second option. If your HSA is too big and you might never spend it, do you have another option? Yes, starting at age 65, you can essentially utilize HSA dollars as if they were in a traditional IRA. You can spend that money on anything, not just on medical expenses. Those withdrawals, though, will be treated as taxable income, no longer as tax-free income. So there's a trade-off there. The best choice, in my opinion, would be find health-related reasons to spend that money on, or even better, when you're younger, is to start tracking your medical spending and at some point in life, start paying yourself back out of that HSA account, which you can always do. Again, if this is your first time hearing this, quick little aside, you can save receipts. I could have saved a receipt from 2012 and built my HSA over years and years and years to wherever it is now. And here in 2025, I can pull out that receipt from 2012 for, $111 for a checkup, and I can reimburse myself today using my HSA for a receipt that's 13 years old. Or another way of putting it is, as a retiree, right, you can have tens of thousands, if not hundreds of thousands of medical receipts over the past 40 years of your life that you could reimburse yourself for from your HSA. And it is much better to do that than to die with an HSA, leave it to a non-spouse heir, and make it taxable income for that person. What about annuities? So all else being equal, I prefer not to purchase annuities in the first place, almost all the time. Even the few good annuities, like a SPIA, which I'll talk about right now, even the good annuities, to me, don't have enough investing merit to really interest me. I think the math is pretty clear. So a SPIA, a single premium immediate annuity, is about as good as annuities come, but the rate of return math isn't attractive for me. Again, it's a very simple annuity, a SPIA. You trade in a chunk of your money today for lifetime income. Again, usually starting today. Usually it's immediate. Well, I shouldn't say usually it is. The I stands for immediate. You should think of this as longevity insurance, where you and other SPIA customers are essentially pooling your risk together. It's exactly like the inverse of term life insurance. You and a bunch of other people are pooling your assets together. And with life insurance, those who die early get a payout, and those who die late do not. With an annuity, those who die early basically don't get their money back, and those who die late get their money back and a lot more. As I'm speaking this into the microphone, a 65-year-old male can purchase a SPIA with a 7% annual payout. And note, the payout is not the same as a rate of return because the annuity first pays you back your own money. But if we use simple internal rate of return IRR math, we see what a 7, or in this case, I think right now, the SPIA rates are 7 or 7.5%. I'll round up. I'll say 7.5. A 7.5 payout rate means that if our 65-year-old male dies at age 80, he would have received a 1.5% rate of return for 15 years. If he dies at age 85, he would have received a 4.2 annual rate of return for 20 years. If he dies at age 95, he would have received a 6.3% rate of return for 30 years. And, we can look it up. We know that the average 65-year-old American male will live to age 82 on average. So in this annuity, if someone lives to age 82, would provide a 2.8% annual rate of return for 17 years. To me, that math is simply not good enough. But okay, let's assume you already own some annuities and you really like them. Much like Social Security, your annuity income can create a fixed floor from which you build the rest of your withdrawal strategy. Pension income works the same way. It creates a floor. Now, if you have control over collecting your pension or annuity income, it's definitely worth understanding if and how delaying those income sources might open other doors for you. Again, maybe it's income doors, maybe it's tax doors. Again, the oft-mentioned Roth conversions. But everybody's pension and a lot of annuities work in unique ways. So last, I want to talk about some common mistakes when it comes to the retirement withdrawal order of operations, common mistakes and how to avoid them. The first common mistake is just not having a plan. I know this is a cop-out, but this exercise is about building a plan to maximize your after-tax wealth throughout retirement. It's about planning ahead, and perhaps there's no greater mistake than deciding not to plan. The one cliche is, failing to plan is planning to fail, and it's very true here. The second common mistake is assuming that every year will be the same. Your spending will change, your portfolio will grow and occasionally shrink. You'll hit age milestones such as your Social Security window, Medicare at age 65, RMDs at age 73 or 75 or beyond, depending on legislation. You cannot assume that every year will be the same. Your withdrawal strategy cannot be static. The third common mistake is missing annual windows. If you forget to stuff your brackets, if you neglect a Roth conversion in a particular year, you can't get that opportunity back. Once a year has passed, so have your tax opportunities for that year, so don't miss your windows. The fourth common mistake is the ignorance of adverse interactions. Oops, you didn't realize that extra IRA withdrawal would push you into the next IRMA bracket. You didn't know that Roth conversion would make Social Security more taxable. One of the challenges of a withdrawal strategy is understanding how these puzzle pieces all fit together. So don't make the mistake of not knowing your adverse interactions. The fifth common mistake is spending the wrong assets too soon. So again, Roth and HSA assets tend to be your most valuable compounders. Taxable assets should usually be spent first, but not necessarily if a near-term death might prevent large capital gains realization. So the fifth common mistake is spending the wrong assets too soon. Your ideal retirement withdrawal strategy will be a function of you and your unique circumstances, but the framework provided here today in this episode should give you an excellent starting point going forward. Think about it. You spent decades of time saving and accumulating and investing, And getting this step of retirement planning, of withdrawal optimization, is just as important as those decades of time. A little math and a little planning can add so much value. Isaac, thank you for the awesome question. And listeners, thank you for all the awesome questions. I hope you keep them coming. And now that we're doing monthly AMA episodes, I should be able to tackle more questions more often. So thanks for all the emails. You can send them to jesse@bestinterest.blog, and we'll talk to you next episode.
Thanks for tuning in to this episode of Personal Finance for Long-Term Investors. If you have a question for Jesse to answer on a future episode, send him an email over at his blog, The Best Interest. His email address is jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves. And we really appreciate it. We'll catch you on the next episode of Personal Finance for Long-Term Investors. Personal Finance for Long-Term Investors is a personal podcast meant for education and entertainment. It should not be taken as financial advice, and it's not prescriptive of your financial situation.